en Florida. En los próximos minutos vamos a estar hablando, como les digo, con Jay Pelosky, que ha estado sumamente claro dentro de todo lo que tiene que ver con lo que pasó con el presidente Trump. Ahí creo que lo tenemos en pantalla. Ya vamos a decirle quién es, pero Jay, I'm very happy to have you here, and obviously I think that the most important part is what do you think is going on in the tariff? What do you think is going on with the government? Because, and before you start speaking, when I was reviewing your appearances in other outlets, you were completely right about the potential negativity on the tariff and the potential economic policy of the administration. Thank you for coming, Jay. It's a pleasure to have you here.
Thank you, and happy to be with you. So, look, markets hate uncertainty. That's the basic rule. And all this talk about tariffs back and forth, some days on, some days off, are creating uncertainty. And so the epicenter of that uncertainty is the United States. And therefore, it makes perfect sense that U.S. assets are the ones that are suffering the most. Whether you look at stocks, whether you look at the dollar, it really is self-harm in a way. And look, the administration has made it clear that it is willing to take economic pain in order to refigure the economy as it sees fit. And investors have had to come to realize that President Trump, who cared a lot about stocks and stock performance in his first term, in his second term is much more focused on interest rates and lowering interest rates. And to us, you know, we wrote a piece a month or so ago called The Stoic Strategy, right? Going back to the classic Greeks and their thesis of imagining all scenarios and thus fearing none. And we added to that the corollary of paying more attention to what President Trump does than what he says. And what he does and what he wants to do is cut taxes. And so tariffs, in our view, is a way to raise money and reduce the deficit and provide more space for tax cuts. That's really the thrust, both for tariffs, we believe, and for the DOGE cutting of spending. It's all in the service of trying to create fiscal space for a big tax cut, because the U.S. budget deficit at 7% of GDP does not allow for any more tax cuts that are not paid for. And so this is really the essence as we see it.
Jay, obviously you explained us that, and you're absolutely right. We need to pay attention of what Donald Trump is doing, not what he's saying. And not only you, but other major economists and analysts are exactly saying what you just mentioned about that the tariff will be a mechanism to raise revenue in the face of potential cuts. But what, in your opinion, is the risk right now that we may have a period of estanflation within these next couple of quarters in 2025, and in the event that this is temporary, as the Fed used to say, transitory, do you think that at some point the market will assume the new reality or the new normal? Or you think that the administration have to unwind based on a very difficult recession this year?
Yeah, that's really the big question, I think, is exactly that, you know, whether we're going to have a recession or not. Look, first off, there's an opportunity here, right? The risk is in the United States. The opportunity, as we see it, is in the rest of the world. So we think a lot of this Trump uncertainty is creating the catalyst for a secular change in global equity leadership away from the United States, which has been the leader since the great financial crisis in 2009, to the rest of the world. So I would encourage your audience to think globally. I believe it's the best time to be a global investor than at any point in the last 15 years. And so there's a real opportunity here. Now, that opportunity is at risk to a U.S. recession. And here's why. For non-U.S. equities to outperform, it needs a U.S. equity market that just kind of meanders along, right? If the U.S. is up 20%, as it has been the last couple of years, no one cares about international. If the U.S. is down 20%, everybody sells everything, including international. So what we need is a single-digit type return environment for the U.S., which is what we forecasted when we wrote our 2025 outlook last November, that the U.S. equity market could grow as earnings grew, because there's no room for multiple expansion, right? It's already the most expensive market in the world, most expensive relative to its own history and to the rest of the world. And so here's where the rubber meets the road. If the tariffs and the immigration and the uncertainty create an environment of weak growth, yet high inflation, that will put the Fed in a box and not allow the Fed to cut to support growth. And that would lead to earnings disappointing, and that could lead to a second leg down in the U.S. equity market, where we've already had a very rapid 10% correction. And by the way, the rest of the world technically took that test and passed it very nicely. So the S&P, NASDAQ, Magnificent Seven, all broke below their 200-day moving average. ACWI ex-US, EFA, emerging markets, all stayed above their 200-day moving average. So we've had a test of the thesis that the non-US markets are outperforming already, and it's passed with flying colors. Again, the risk is that recession, no Fed, US bear market, that's going to be a more challenging test.
Yeah, but the question is, and I want to ask you that because obviously you've been studying the behavior of not only the economy, but leaders. If we enter into that scenario, which is most likely because the money is going out and President Trump has been saying, and yesterday more loudly, that he's going to impose those tariffs. Do you think that was my previous question, that scenario would definitely lead President Trump to change and unwind? Because what is the other possibility he have if the tariff are the triggering point for such a scenario that is basically the stagflation? What the administration might have to do so we can again try to compete with a world that probably seems to be better prepared with this scenario all of a sudden, Jay?
Yeah, I mean, I think the administration's response to that would be that going forward, after the tariffs and after DOGE and all the confusion, we would get some clarity around deregulation and tax cuts. And that would make the market feel better and things would kind of stabilize and move forward. You know, I'm personally not so sure. I don't think the U.S. economy is going to go into recession because we enter the Trump years as the strongest economy in the G20, right? The strongest economy amongst the developed economies. And so President Trump has done an amazing job in weakening that strength in a matter of months, which is scary. If you think about how many more months can we handle this? And so that's why I say the president has said that, he's willing to take some pain. How that plays out in the markets, that remains to be seen. I think it's a dangerous game because the U.S. is much more exposed to foreign capital leaving the United States than anything else. And if you start to get a period of capital repatriation out of the U.S., back to Europe, back to Asia, back to Latin America, which I think is happening and will happen, that's going to put pressure on the Trump policy mix And maybe that will lead to, some readjustment of some of this. I mean, that's the thing, right? I mean, because just as much as he puts the tariffs on, he can take them off. And that's one of the reasons why he likes it so much, because he can do it himself. And he becomes the focus of all the attention, which is very attractive to him as a personality. To the markets, obviously, it's not. But again, as a global investor, the U.S. is just one part. You have all of Europe, all of Asia, all of Latin America. And so our advice is to focus globally and to take advantage of the fact that for the first time in 15 years, non-U.S. markets are outperforming. And we think it's the beginning of a secular trend. So it's going to last years, and it's going to be reinforced by that capital repatriation that we just spoke of.
Wow, it's a scary movie for us here in the U.S. Jay, and what do you think it will be the potential allocation that you will do now? More in China, Germany, in Europe, any other outperforming country in Asia? Where do you think the bulk of the money is really going? Based on what we're seeing, obviously the ETF of China and Europe are going up, but where is your opinion where the money should be going into the new bull market or so?
Yeah, we wrote a piece last week titled The End of the Beginning. Okay, so the beginning was tariffs and Doge. And those are coming to an end. April 2nd, we'll get the reciprocal tariffs. And hopefully that will serve as some sort of clearing action. I mean, again, today is a pretty good example. At the beginning of the day, markets were quite weak. Trump is talking about a 25% tariff on autos. And so, yes, the auto stocks got hit, but they're a tiny, tiny fraction of the market. Overall, the S&P was down 0.2, 0.3%, not really meaningful. So the tariff ability of the markets to be negatively affected by tariffs has gone down because it's already in the price, right? Now the opportunity is to be kind of done with the tariffs and move on to something else that could be potentially more constructive. And at the same time, the European stocks, like the defense stocks or China tech, those have moved up 30% in a month. So it's good for them to take a pullback, right? To have some profit taken. You don't want it to go up 50% because then it's going to go down 50%. So you want a steady kind of move up on good news. And that good news is, more government spending because of the fiscal space in Germany and China, better growth, better corporate earnings, capital returning. So you have multiple ways to go higher. So one tagline is very simple. We want to sell U.S. rips. If the U.S. rips higher for whatever reason, we want to sell that because we think the upside is capped. We want to buy non-U.S. dips because we think the upside there is considerable going out the next couple of years. We like China a lot. We like Europe a lot. We like Japan a lot. We like commodities a lot. We think commodity space is very interesting. Gold miners, copper miners, oil stocks are breaking out. And that action in the commodities reinforces our confidence in the view that we have that global growth is going to be better than expected. We have a global growth view that is quite positive. Many others are more concerned. IMF cutting growth estimates, World Bank cutting. We think growth is going to be fine, and the commodity action in copper and oil is telling us it's going to be fine.
Jay, thank you very much. Listen, you've been extremely to the point. I think everybody understood here that the opportunity for at least for the next foreseeable future, it should be internationally. We'll see what the administration will do, but we want to invite you back to our program. Thank you very much for staying with us, and we'll talk to you soon, Jay. Thank you.
Yep, thank you very much. Appreciate it. Have a great night.